Okay, let's dive in. We're looking at a big stack of material from BNY Mellon, their quarterly and full year 2025 update. And these things can be, incredibly
Oh,
dense.
for sure. Just a wall of numbers.
Exactly. So our mission today is pretty simple. We want to cut through all that data smog and just pull out the core strategic takeaways, what you really need to know.
Right. We're not just here to read slides. The real question is how. How did a financial giant like BNY Mellon pull off what they're calling record results? Was it just, a good year in the market, or is this transformation program, their phase one, actually paying off?
And what does it mean for what's next, for phase two?
Precisely.
Okay, so let's start with the one number that just jumps off the page, the hook. For the full year 2025, the reported EPS was $7.40.
hmm
That's up 28% year over year. I mean, even if you strip out the notable items, it's still up 24%. That's a huge number.
It's a massive number. And that kind of growth, it needs an explanation. It's not just the market was up. The key term here, the one they keep repeating, is operating leverage.
Which, put simply, just means your revenue is growing faster than your costs, right?
Exactly. It's the ultimate proof of efficiency. And they didn't just hit it for one quarter,
No, they hit it for all 4 quarters of 2025.
which brought the total streak to 8 consecutive quarters. That tells you something structural is happening. It's not a fluke.
That really sets the stage perfectly. So let's zoom out to the big picture. The full year consolidated results.
Do it.
Total revenue hit $20.1 billion. That's up 8%. A solid number.
Solid, but wait for it.
Right, because look at the profitability. Pre-tax income was up 21% to $7.1 billion.
There it is.
And net income up 22% to $5.3 billion.
And that gap, that difference between 8% revenue growth and 21% income growth.
Yeah.
That's where the magic is. That's the efficiency story right there.
It's a huge delta. Their pre-tax margin jumped 4 percentage points in 1 year to 35%.
Which, for institutional investors, is great. But what they really care about, especially for a capital-heavy business like this one, are the returns on that capital.
Of course. So let's talk about ROE, return on equity. That hit 13.9%, up 2 full percentage points.
Good. Very good.
But the one that really gets all the scrutiny, return on tangible common equity, or ROTCE. It reached 26.1%, an improvement of 3.3 percentage points in just 12 months.
And for anyone listening, that ROTCE number is so critical. It strips out all the intangible stuff like goodwill and just shows you how well management is using the real, cold, hard capital they have.
And 26.1% is?
It's exceptional. For a custodian bank of this scale, that is a fantastic number.
They must think so too, because look at what they did with that cash. A 94% total payout ratio for the year.
94%. They gave almost everything back to shareholders.
And they hiked the dividend by 13% in the third quarter. That's a massive signal of confidence, isn't it? They're basically saying, we don't need to hoard this cash to grow.
Well, they should be confident, because this isn't just a one-year trend. If you put this in historical context, it's startling. Okay, so look at the decade before this big transformation, from, say, 2012 to 2022. Their adjusted EPS grew at a compound annual growth rate of about 7%.
7%, which is, respectable for a company that size. It's not bad.
It's not bad at all. But during this recent transformation period from 2022 to 2025, that same metric, the EPS CAGR,
Yeah.
it wasn't 7%, it was 18%.
18. Wow. That's more than double the growth rate of the entire prior decade.
And that's the aha moment. That's the proof that something fundamental has changed.
Okay, but let me play devil's advocate for a second.
Yeah.
That 18% is aggressive. How much of that is just market tailwinds? Higher interest rates, rising stock markets in 2025. How do we separate that from their internal changes?
That is the perfect question to ask. And the answer goes right back to operating leverage. The market absolutely helped revenue, no question.
Yeah.
But look at that prior decade we just mentioned. Their average operating leverage was actually negative 24 basis points. It cost them more to make another dollar.
Right.
In 2025 alone, it was a positive 507 basis points.
All right.
That kind of swing isn't just riding a market wave. That's strategic discipline. That is a permanent financial advantage they've built.
Okay, so the proof is in the leverage. That makes sense. Now we have to get into the how. How did they do it? This all comes from what they call phase one, setting our foundation.
Yep. It ran from 2023 to 2025. And it really seems like they were rebuilding the engine while the car was running.
So what was the trade-off there?
This is what's so fascinating. They generated about $550 million in efficiency savings.
Okay.
But instead of just letting that drop to the bottom line to make the quarter look good, They immediately reinvested about $500 million of it.
Right back into the business, into tech, client solutions people.
Exactly.
But wait, that's a tough sell for investors, isn't it? Generating all these savings and then immediately spending almost all of it? Shareholders want that profit now.
It's an incredibly hard sell. But this is where the strategy was so smart. The 8 quarters of positive operating leverage proved that the investments were paying for themselves almost immediately. They were generating efficiency faster than they were spending the money.
They weren't just cutting costs, they were changing the cost structure itself.
Precisely. And the absolute centerpiece of that effort was artificial intelligence.
Oh, they have been so aggressive on this. They launched their internal AI platform. They call it ELIZA 2.0.
Mm-hmm.
And the adoption rate is something I've almost never seen. 99% of employees are using it.
It's not just a memo that went out. This is deeply embedded. They have 160 enterprise AI solutions already in production.
And this is the stat that got me. They have 134 digital employees.
Right, which are basically AI bots automating entire workflows from start to finish. And they've filed over 60 AI-related patents just in 2025.
Just to give you an idea of what that means, imagine a bot that can reconcile millions of transactions a day, spot errors, flag compliance issues, all faster and cheaper than a human team could.
It's a massive unlock of capacity. And this AI push happened alongside a huge organizational shift. By the end of 2025, over 70% of their people were working in this new platform's operating model.
And half of that transition happened just in the last year. That's a blistering pace of change.
It is. But this wasn't just about internal savings. It was also about positioning for the future, like their leadership in digital assets.
Yeah, this part is key. It's about future relevance.
Absolutely. They're launching tangible products.
Yes.
Stablecoin reserve custody, the BNY Dreyfus Stablecoin Reserves Fund, tokenized money market funds. They're trying to build the plumbing for tomorrow's financial system, not just watch it happen.
Okay, so the foundation is set. Let me talk about where the money actually came from in 2025. Let's look at the segments.
Right.
Starting with the biggest one, security services. The custodial backbone. Total revenue here was $9.7 billion, up 9%.
And that was really high-quality growth. It was fee-driven. Asset servicing fees were up 9%, issuer services up 11%.
And it all just comes back to their unbelievable scale. Assets under custody and/or administration, AUCA hit $43.0 trillion.
It's a number that's hard to even comprehend.
43 trillion? That's like, what, twice the GDP of China? It just shows you how fundamental they are to the global financial system.
It makes them indispensable. Okay, next up, market and wealth services. Also a great year. Revenue was up 12% to $7.0 billion.
But this story is a bit more nuanced, isn't it? The growth wasn't even across the board.
No, not at all. The real star here was clearance and collateral management. That was up 13% year over year.
Driven by higher market activity, clients needing to manage risk.
Exactly. And that really strong performance helped cover up some, say, more muted growth in other areas. Like Pershing, their broker-dealer platform, was up 4%. Solid, but not explosive.
Which brings us to the most complex part of the story. The one that requires a closer look.
Investment and wealth management.
Yeah. Here, total revenue is actually down 4% for the year. How does that happen when the rest of the firm is flying?
So the drop was mostly driven by the investment management side, which is down 6%. And this is a really crucial detail, because even though their total assets under management, their AUM, rose 7% to $2.2 trillion.
Which sounds good.
It sounds good, but that was mostly just higher market values and a weak dollar. The underlying story is that the segment saw cumulative net outflows of $37 billion in 2025.
Wait, hold on. So clients actually pulled $37 billion out, but the total number still went up because the market saved them.
That's it in a nutshell. It implies that for all the incredible efficiency gains, this core segment is still struggling with client retention or acquisition. The market's performance basically papered over a net loss of client money.
That's a huge headwind to acknowledge.
It is. Now, to be fair, there was also a technical accounting change that hurt the revenue number a bit, but the outflow issue is the real story there.
Okay, so with phase 1 done, they're now all in on phase 2, scaling platforms and growth ambitions. What does that actually mean? How are they going to fix that outflow problem?
It's all about leverage. Leveraging the new infrastructure. They want to finish the transition to the platforms model company-wide and then start selling integrated multi-platform solutions to clients.
So cross-selling between the segments.
Exactly. Use the internal efficiencies to drive new revenue opportunities.
And the AI ambition is getting even bigger, right? I saw the phrase AI for everyone, everything, everywhere.
That phrase says it all. They want to use those digital employees not just for back office tasks, but to free up their human talent to focus on clients, on growth. Those platform efficiencies have to start driving organic growth.
So what are they projecting for the year ahead? Let's look at the 2026 outlook.
Okay, so for 2026, they're guiding to slower top-line growth, total revenue up 3 to 4%.
Yeah.
But here's the interesting part. Expenses are actually projected to grow a little faster, up around 5%.
Why are expenses going up? Isn't this whole thing about efficiency?
It is. But that increase reflects the spending needed to finish phase 2, plus some higher revenue-related expenses. But,
Yeah.
and this is the crucial part, even with that higher spending, they are still targeting positive operating leverage of over 100 basis points.
So they're still committed to that core discipline. Revenue grows faster than baseline costs, even while they're investing heavily.
That's the plan.
And you can really see their confidence from phase 1 because they didn't just meet their old targets, they blew them up and set much higher ones for the medium term.
Oh yeah, they're showing huge conviction that these changes are permanent. They raised their adjusted ROTCE target from 23% to now 28% or more.
And the pre-tax margin target went from 33% to 38% or more. That's not just a little tweak. They believe they're operating on a whole new level of profitability now.
It's a massive reset of expectations.
So let's bring this all together for you, the listener. The core story here is that BNY Mellon's big transformation, phase 1, worked. They used efficiency savings, a lot of it from AI, like ELIZA 2.0, to fund new investments. And the result was record profitability, record ROTCE, and this incredible streak of positive operating leverage.
Right, and phase 2 is about taking that new efficient machine and turning it into a growth engine to leverage their massive scale and security services while trying to solve the competitive challenges in investment management.
So here's the final thought for you to chew on. Given how much they've invested in AI and these digital employees and how successful the efficiency program has been, what happens to their growth in traditional service areas if the markets just go flat for a couple of years?
That's the billion-dollar question, isn't it? Especially with those net outflows we saw in investment and wealth management. How will these big phase 2 priorities, like building markets on distributed ledger technology, balance against the short-term need to stop clients from leaving? Will all this AI efficiency allow them to just slash prices and win on cost? Or will they use it to create new services so innovative that clients can't afford to leave?
That's going to be the real test, moving from setting the foundation to building the skyscraper. That's what we'll be watching.